Hello everyone, welcome to my my final video on ratio analysis, looking at profitability margins. So there are three margins that we can look at. We're taking advantage of the profit and loss account and using these to measure kind of efficiency in the business. How efficient is the business in turning its revenue into its different types of profit? And this can be really useful for managers. So in order to do these ratios or these margins, you need to have a good knowledge of the profit and loss account. So if you're not too confident with that, I suggest you go back at one of my other videos and look at that accordingly. So we're going to look at some of the different profitability ratios for this business. So the first one we're going to look at is the gross profit margin. Now the gross profit margin shows gross profit as a percentage of revenue. So in order to calculate that, we put our gross profit over our revenue and then multiply it by 100, which I've done over here. So if we take our gross profit of 9 million and divide it by our revenue of 26 million, then multiply it by 100, we get 34.62%. And what that means is, for every pound of revenue, 34.62% is gross profit. So it gives us an idea of how good the business is at turning revenue into gross profit, or profit after the cost of sales have been paid. Now, you can improve the gross profit margin in two ways. One, you can try and reduce your cost of sales. But if you're reducing things like the money that you're spending on materials, if you're changing them, it's possible it might affect your product quality, which might have a negative effect on your revenue if the customers aren't happy with that. The other thing you can do is increase the price, which, depending on the elasticity of demand, may have different effects. So if you've got inelastic demand and you boost the price, your revenue overall will increase. But if you've got elastic demand and you reduce the price, then your revenue is likely to fall, which will mean that it will have a negative effect if you start boosting the price. If you cut the price, though, you will increase your number of sales and but ultimately, your profit margins will shrink. So, two ways: you can either boost the price or reduce your cost of sales. And if this is too low, it's possible that there might not be enough cash to cover the business's overheads, which may present some difficulties for the business. Certainly, it will mean kind of negative end-of-year profit down the line. Okay, our next profitability margin is the operating profit margin. What that is, it's operating profit as a percentage of revenue. So we take our operating profit here of 5 million and we divide it by our revenue of 26 million, and then multiply it by 100. So 5 divided by 26 times 100 gives us 19.23%. So what that means is that, for every pound of revenue, 19.23% is being turned into operating profit for the business. So it can be improved in two ways. Firstly, you can increase all the things that increase your gross profit margins will ultimately increase your operating profit, because it's moving on down accordingly. Mainly because your operating profit is taken by taking your overheads away from your gross profit, which we looked at in a previous video. So anything that boosts your gross profit is going to improve your operating profit as well. The other thing you can do is try and reduce your overheads. So maybe if part of the factory you're not using, maybe you don't have to rent that part of the factory, or look at other ways of reducing those costs. Maybe trying to increase your capacity utilization, for example, so that your fixed costs are split over more units, for example. Good. So, and if you don't have enough operating profit, that's going to affect your ability to invest in the future. It's going to affect your return on capital employed statistic, by which a lot of businesses are measured, and it may mean that you don't have enough money to pay dividends to your shareholders, which will make them less than happy. They might sell their shares. It might create all sorts of problems for the business. And finally, we have the net profit margin. Now, the net profit margin is the percentage of revenue that is kept as net profit after the tax has been paid. What will be turning into profit at the end of the year? So in this case, we're taking our profit for the year of 4.5, dividing it by our revenue of 26, and timesing it by 100 to give us 17.31%. Yeah. So that means for every pound that's in the business takes in revenue, 17.31% is being turned into profit after all costs of all descriptions are paid for. And you can improve the net profit margin in a number of ways. You can boost your operating profit, boost your gross profit to boost your operating profit to boost your net profit margin. But also you can try and find a better accountant or try and be more efficient at paying as little tax as possible. So perhaps a large business might register themselves in a tax haven like the Cayman Islands, for example, in order to reduce their tax bill. Ultimately, the net profit margin is what the business uses to pay out dividends to shareholders and what it uses to invest back into the business in the future. So that's a really important statistic. There are two other things I want to talk to you about. You can also use these statistics to help you calculate what the percentage of the revenue is being spent on different costs. So I'm just going to give you one example of this. So let's say we wanted to find out how much of the business's revenue is being spent on overheads. Well, we can use two margins in order to calculate that. So what we want to do is basically find out what the difference is between our gross profit margin and our operating profit margin. And we know that that will be what is being spent on operating profit. So we take our gross profit margin of 34.62%, and we're going to take away our operating profit margin of 19.23%, which should give us 15.39%, which means this is how much is being percentage spent of revenue on overheads. So it might give the managers an idea of how much money is being spent on their overheads, and they can think about whether that's a major cost for the business. I can tell you that for this business, certainly the majority of their costs do seem to be going out on gross profit. So you could flip this gross profit margin. So 100, you take obviously your revenue would be 100%, take away 34.62 would give you how much of the revenue is being spent on cost of sales as a percentage of revenue. So that can be really useful for managers. The last thing I wanted to talk to you about was a thing called profit quality. Now, profit quality is to do with whether the profit the business is making can be done again and again. So if it's selling a good or a service, the business can continually make that, and that's considered high quality profit. However, if they're making a profit that's off a one-off sale, let's say they had a building and they sold that building, they can't sell that building again and again and again because they've only got one building. They're not, unless they're a building firm and making buildings, they can't keep selling those buildings. And that's what we call low quality profit. And the problem with that is your one-off sales and one-off expenditures enter the profit and loss account before the operating profit. So that one-off sale of a building will be included, come in at this overhead section, and it will change your operating profit statistics, and that will have a knock-on effect on the operating profit margin, the net profit margin, and also the return on capital employed. So if you've got a business that has made a one-off sale of a building that it can't sell again, and that's included in its operating profit, it's possible that its return on capital employed and its, by association, the operating profit and the net profit margin, then that business can look a lot more profitable in the short run than it's actually going to be in the long run. So that's one thing that investors should always be wary of. Is their operating profit margin being increased by the sale of one-off items that cannot be repeated in the future? So that's a stumbling block for many investors. Just being aware that there's the possibility that one-off payments may be reducing or giving the impression that the business is more profitable than it is otherwise. Anyway, I hope that's been useful to you. I shall see you next time.